our money where we are getting the higher lifetime value from the customers. One of the example is the lab-grown product, which is continuously performing well, and that we are marketing and targeting the customer through the paid media on web. That is driving the higher ASP towards that. ASP normally we keep a range of, for a business perspective, around $40. But we are targeting based on the profitability of the customers. So right now we cannot guide on the where the price will fall of digital consumer, but it will be on the profitability side wherever we would like, if the customer is giving more value.
Understood. Like you mentioned that LGDs are about $250 ASP, and the share has been growing. So I was just trying to understand if that share goes further. So if this can move further up, beyond $40 as well.
But definitely that will be the acquisition product. But then the repeat will come that with the different offerings from jewelry to lifestyle products. That will have the lower selling price. So not necessary that if the price is $250, it will remain same. The different product bouquet we have from $5 to $1,000 with 30,000 different SKUs. So that's where the average price becomes low.
Understood. And what was the revenue from the OTT channel this time in Q3? I think that number was missing in the presentation.
It is not with me right now, but Prashant will come back to you on the OTT numbers.
Okay. And so how are we seeing the conversion trend in the OTT channel? We were making a lot of investments in that channel. So is that investment trend continuing, and how is the conversion trend that you're seeing there?
Sunil, would you like to take this?
Yeah, so we're continuing to make the investments. There are two reasons for that. We are seeing the audience migrating a lot towards OTT channels. There is a Fire TV, Roku, Samsung TV, or Hulu TV. There's so many of different platforms. In fact, the OTT viewership right now is almost 4 times the linear TV viewership in the U.S. So we are continuing to make investments, and we are seeing the lifetime value of OTT customer much higher than TV customer also. The challenge in OTT is once you get customer to download through paid media, once they download, it is difficult to retarget that customer because the OTT ecosystem is not as evolved as the mobile app or the online system is. We are continuing to explore more and more advertising options and continue to explore those areas. The revenue continues to improve YOY. I don't have the exact number, but we are continuing to make the investment and continuing to expand in that area.
Understood. And one last question, sir. So we had this target of reducing our break-even timeline for customer acquisition cost from about 9 months to 3 to 6 months. So where are we on that journey at present, and is the trend encouraging?
Yeah. So we have total 6 brands. So 2 of those brands have already achieved 3 months break-even, and the rest are between 5 months to 9 months period. And we are learning every day and experimenting with different products, different offers, different landing pages, and getting to and shortening the time. And as we shorten the time, we'll continue to scale those brands up. And that is one of our growth strategies going forward in the future.
Understood. Thank you so much for answering the question.
Thank you. The next question is from the line of Deepesh Sancheti from Manya Finance. Please go ahead.
Hi, am I audible?
Yes, sir. Please continue.
Okay. Now, I just wanted to understand, in jewelry, how much is the sales from gold, silver, and artificial jewelry? Hello?
Hi, Deepesh. So, plain gold, we don't have much. Majorly, we do the casted jewelry, studded gemstone or diamond or lab-grown product. Plain gold, as our guardrail of keeping the margin 60 and above, doesn't meet, so we don't do unless there's a designer jewelry. We do that part, but the margin guardrail just that product normally do not meet. So that is why the proportion is comparatively very low compared to our major product is gemstone jewelry.
No. I'm just trying to understand that in the jewelry segment, which is approximately 65% of your sales, how much is in terms of in a gold product, in a silver product, and how much of it is artificial jewelry? And does that all have the same margins or not?
That I mentioned about that, these are the proportion from gold, silver and platinum with the studded gemstones. So gold portion will not be a significant one in the product cost. So we target based on the different gemstones. So we don't have right now that how much gold portion will have on those products. But the major part is mostly gemstone.
How much of your products, I mean, even in studded, how much of it is done in gold, how much of it is done in silver, how much of it is done in platinum, if you can have that have the bifurcation?
Got it now.
Yeah,
so majority of the product, yeah.
Yeah. Dipesh, I can give you rough numbers. I don't have the exact breakup, but approximately 70% of our jewelry would have silver, gold or platinum component up to it. And by value, I'm saying. And the 30% would be base metal. There is brass or copper or stainless steel.
Great. That's it. That's good enough.
Yeah, that's just a rough number. So what Nitin can do is to get the data more detailed and get that out to you later.
I think we can contact the IR for that to have the exact numbers if you can have.
Sure, yeah. Prashant will arrange for you.
Great. And just wanted to understand also the U.S. exports. Is it going fine? Because you had mentioned that, you are casting over there, getting it here, finishing and going back with only 5.5%, I think what you mentioned last con call. So is that working well, or are we facing any duty challenges?
No, that is working well because we are casting there and we have the Custom Border Protection ruling specifically for our company, stating that this process is as per the law. In this case, we are paying 5.5% tariff only on the value addition and not on the casting component.
Great.
That is zero.
Great. And your lab grown is done mainly in gold or in every metal, in every precious metal?
Pretty much every precious metal, silver, gold, platinum, everything.
Silver, gold, platinum. Okay. Are you seeing any traction more in silver? Because because of the high gold prices, a lot of lab-grown jewelry has started coming into silver. Are you seeing that kind of traction, or it's working well in all the three metals?
For us, it's more platinum and silver. Gold velocity actually reduced after prices shooting up. Now, silver has recently shot up exponentially. So we don't know how the silver with the new prices fare up in lab grown. But right now it's doing well. But going forward, we don't know. So what we're doing is testing into more different metals, like base metal with a lower carat weight, lab grown, and see how that consumer takes up. So we constantly bring new product, Dipesh, 100 new products every day. There's a very high velocity of experimentation, testing, and then new product coming to customers.
Okay. And is this new FTA which has been signed by between EU and India, how are we as a company exploring that opportunity? Because apart from
definitely
we don't have to focus in the other part of EU. That's why.
Yes. So we'll save 4% on our jewelry export from India to Germany. So that will definitely benefit us.
Okay, that will add to our margin directly. Is that a right assessment?
Correct. It will.
Great. And if you can just give us a ROE going forward.
Sorry to interrupt, Mr. Dipesh, but I will have to ask you.
ROE figure,
sorry, can you please rejoin the queue for more questions as there are more participants in the queue?
Okay, no problem.
Thank you. The next question is from the line of Lakshmi Narayan from Tunga Investments. Please go ahead.
Yeah, thank you. When I look at your
unique customer growth, I see the growth has been 2% for the 9 months across. Just want to understand which geographies the growth has been positive and which geographies the growth has been negative. And if you can actually give some idea of whether it is on the lifestyle or in the jewelry. I just want to understand that particular part.
Yeah, hello Lakshmi. So we are seeing the good improvement in TJ in UK. Just digital customers adoption is pretty high over there. Ideal World remain flat and also Germany remain flat. Mainly we are seeing some low customer in US as the strategy of acquisition on digital customers we have moved from low price point to slightly higher price point customers. So that's where the unique customers were lower. Initially we acquired a lot of digital customers through $10 to $30 price point, but we have realized later that those customers are not giving value as we anticipated. And we are seeing that more high-end customers giving more value. So that's where we have seen last 12 months TTM basis, unique customers are lower on US side.
On the US, again, there are two ways to think, right? One is lifestyle, one is jewelry. Another way is digital and non-digital. Where do you see the decline in unique customers in the US market? Which segment of this?
So digital customers, mainly we have seen the change in past 1 year as the customer inflow was very high and mostly jewelry product we were targeting to acquire those customers and in 1 year back. And that is now reduced after the changing of strategy to higher price point targeting. So mainly a US jewelry customer.
And what is your outlook in terms of that unique customer growth? Broadly, what is the internal thought process for FY27? Do you intend to keep the US unique customer growth at somewhere like mid-single digits, or how are you thinking about it?
We mainly target as the profitability of the customers, rather targeting number of customers, targeting quality of customers. So not a specific number, but more a quality of customer we are targeting.
Good. The second question is that if you look at the last 9 months, any specific projects or something which you have actually initiated and that have actually done pretty good for us? Anything you'd like to call out in the last 6 months, last 9 months, where you see either benefits have already come or you think benefits will come actually down the line, which you haven't done the previous year?
There's so many initiatives just to start.
Anything you would like to call out in priority, like 2 or 3 things which you think are...
There's one pure D2C brand called Rachel Galley that we started 4 years ago. So last quarter, we were able to see the good traction on lab-grown diamond and a couple of other jewelry products. And then we scaled up the spend and were able to triple the revenue within that brand. Now, it's a very small base, so that overall it doesn't come up in those numbers. But there is a proof of concept that on digital space, if we are able to crack the code, there is a room to scale up the revenue pretty rapidly. And that we saw with Rachel Galley. Now, we're putting up AI initiatives in different places. For example, AI chatbots. So all the text responses are generated by AI. The email responses are generated by AI. Even the voice response now, we're testing with 10% customer in US. The voice response is by AI. We're using AI for creating our TV schedules. Our calendar is getting done by AI. We have CRO GPT within our business in US. So any question for internal data, we can ask in natural language and get the answer now. At multiple levels, we are implementing AI. The content and everything everybody does, but these are more high value added AI use cases in the organization. Warehouse automation, process improvement in US especially has led to lower operation costs. Now US is running with 320 people at higher revenue, which used to be 500 people 3 years ago at lower revenue. So we're seeing a lot of different areas and initiatives and different places that is bearing of. One initiative that you asked, and I'm just sharing with you, there's a concept called zero distance. The Chinese term called Ren and Hei, held by a higher founder, Zhang Rumin. And last month I went to China to meet him. He's a $55 billion company. He gave me 90 minutes. And we understood from him how they create micro enterprises within the group with P&L responsibilities, and then how they drive the efficiencies, increase the sales, reduce the cost, improve the margins, and that leads to efficiencies. So across BGL Group, now we have over 100 micro enterprises with P&L responsibilities. And we are developing entrepreneurs within our company to drive the business forward. So many initiatives that I can list here, but all these put together gives me confidence that VGL is poised for strong growth in years to come.
Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Naveen Baid from Nuvama Asset Management. Please go ahead.
Thank you for the opportunity. So I had a bookkeeping question. So if I look at your segmental revenue, so there is a disconnect between what is reported to the exchanges and what is put out in the presentation. Can you please explain that?
Let me see 1 second. Yes, so exchange gain specifically is not present in the segment one. It is clubbed between all the entities. You are referring in the investor presentation segment result?
Yes. So if I look at the investor presentation, the segmental slide, your US revenue is at 593 odd crores, right?
Right.
Whereas if I look at what you have reported as an Annexure 1 in the exchange filing, your revenue for US is 685 crores.
Yeah, I got it now. So that is why we have shown separately, because that is the published accounts is based on the geography wise, and here we have separated the retail and the manufacturing. US we have a 2 entity. One is also sourcing entity, so that revenue clubbed in US. But now for the better presentation, that the actual real reflected number in investor presentation. So the other revenue is the sourcing revenue, which done by a separate entity in US.
Okay, but then it's fair to assume that those products are eventually getting sold in the US only. So the incidence of sale, the true incidence of sale in the US is what is reflected in the exchange number of 685 crores. Is that fair to assume?
Yeah, not good. That will not be a comparable number then, because some of the inventory will be remain from those products in US. So fair to compare the retail and the sourcing separately, both sales.
Okay, got it. Just one more question. So what is our current customer acquisition cost across channels? Just some color.
So that would be very, Naveen, that would be difficult to pinpoint because we have 6 brands, and within each brand we have multiple acquisition channels. We have Google, we have Meta. Within Meta, we drive about 10 to 12 different product categories, and each have different customer acquisition costs.
Let me just rephrase the question. So then, what is the ROAS that we generate on the digital performance marketing spend that we do? The return on ad spend is what I meant.
So we look at ROAS, overall ROAS on the store ROAS basis. We look at 2.5 as a target to us that we should generate, because our margin is about 65%. At 2.5 to us, we are break-even. And then we try to get that customer to purchase again and again in future with us. So from all marketing put together, there is Meta, on Google, AppLovin, affiliate, and email, text, all those marketing. And that's the overall company target that we look at, or the brand target we look at. But individual channels may differ. Some channels, for example, Meta, lab-grown diamond, one-day click, accrual ROAS, we are okay with 0.4 or 0.5, 0.4, 0.5. Because then that eventually we know flows into the other channels and then email or direct or whichever, and then goes to 2.5. So it's a bit complicated across different product categories and different channels.
Okay, got it. Thank you. That was helpful. Thank you.
Thank you. The next question is from the line of Tripti, an individual investor. Please go ahead.
Hello, sir. Am I audible?
Yes, ma'am. Please continue.
Okay. So, sir, my question is India and UAE FTA trade deal was concluded yesterday, removing the 4% duty on jewelry. Your German revenue has been stagnant, and you cited a 9% digital drop last quarter. So, since your Jaipur unit are already shipping to Germany, will you use this 400 basis point margin tailwind to the lower price and fix the digital decline, or will you let the flow bottom line ensure Germany doesn't slip back into the loss and seasonally weak Q4?
Good question, Tripti. Thank you. So we will. Our aim would be to get to a revenue growth of 10% or higher in Germany with EBITDA contribution to the group. So within that objective, we will look at what works best. Should we reinvest some of that into the customer acquisition or to let it flow? So that will be decided on a pretty dynamic way. So at this time, it will be difficult for me to give a guidance how exactly it will play. But our business is very dynamic. There is a TV, web, and multiple product lines. So we look at pretty dynamically.
Okay. And one more thing, that you had multiple leadership realignment in Germany over past 18 months. So is current team permanent, or should we expect more reconstruction in cost in FY26?
Yeah, we're pretty happy with the team that we have now, and they are coming together very well, and they're performing. As you saw last quarter, there was revenue growth. From quarter before, there was no revenue growth. Last quarter, there was revenue growth. The gross margins are higher, EBITDA positive, and it's profitable. So we're very happy with the team coming together and performing.
Okay, so there is no change in team, right?
No change. No major change expected. Some additional spaces to fill, but there is all middle level only. But nothing, no senior changes or no major changes.
Okay. There is a last question. You can consistently beat your lower margin, 7 to 9%, whatever you guided. Then, given that you grew 16% in US this quarter, so why are you still maintaining such a low guidance for full year?
For first part, I'll take some. So, Tripti, so US growth 16% is not apple-to-apple comparison, because that includes the sourcing unit growth. But you can refer the investor presentation. That will be the better in line with the comparable number. So US in past quarter, we have a growth of 8.7% in local currency terms. That is the more comparable number.
Rupee terms. This is rupee
in rupees terms. Yeah. And before next year, we are guiding that 9 to 11%. So that is definitely the other initiatives helping, and that is why we are guiding the higher number for the next year.
Okay, thank you so much.
Thank you. The next question is from the line of Deepesh Sancheti from Manya Finance. Please go ahead.
Yeah, a couple of questions from here. Can you hear me first?
Yes, Deepesh.
Yeah. What is the labor code impact on our company in this quarter?
Yeah, I'll take that. So this labor cost impact was not a significant, around 1.7 crores, so that we have accounted in our employee cost.
Okay. And going forward, what is your ROE expectations? Because in 9 months you've done ROE of about 15%. And in 2022 we were about 20%, 23, 32, that kind of a number. So when do you see that number actually going to 23, from 15 to 2023? Hello.
Yeah. So Dipesh, difficult to guide the exact timeline for that. But what I expect that we already given the guidance for next quarter for the EBITDA number, and we don't foresee a major capex, except some in UK, but nothing exceptional capex. So ROE and ROIC both should improve next year, and in medium term they should continue to improve. And so what I'm guiding is that we should continue to see leverage next year and in midterm.
So the trajectory will be upwards.
Yes, trajectory will be upwards. Correct.
Right. And if I can just put in one more question, that how much of your lab-grown sales actually come from a carat and above? Because that's where the real margin would be, I'm assuming.
Nitin, do you have an idea?
No, we don't have that number handy with us.
Very micro question. It's a good question, Dipesh, but it's a very micro question. So Prashant can probably... But I can give you a general idea that from my back of the envelope estimate, about 70-75% of sales would come from 1 carat and up.
Great. That's good enough. Yeah. Thank you so much. All the very best, guys.
Thank you, Dipesh.
Thank you. The next question is from the line of Shreyans Jain from Swan Investment. Please go ahead.
Hello, can you hear me?
Yes,
Yes, sir. Please continue.
Yes. Yeah. So my first question is, when you're guiding for 9 to 11% of top line growth, what sort of INR depreciation are we building in this guidance?
Yeah, so we'll have benefit of first 2 quarters, assuming that now rupee stays where it is, so it doesn't slide any further more. So first 2 quarters will have benefit, and we don't expect much benefit for second H2 of next financial year. So I don't have exact numbers that we calculated with me right now, but it's just overall benchmark, overall framework is H1 will have benefit, H2 won't have much.
And so given historically the rates at which INR depreciates, would it be fair to assume that 5 to 6% is our constant currency guidance in that 9% growth rate?
I don't have the exact number, Shreyans, but I do. Long term, rupee has depreciated about 3.5% against dollars.
Right.
So, but first 2 quarters would have more than that, and next 2 quarters would have less than that. So the calculation that we've done in detailed calculation is not with me right now, but there is some component of depreciation in the guidance that we've given.
Okay, all right. And so the other question is on our acquisition of Mindful Souls. Since our acquisition, I think the revenue run rate has been constant at about $4 million. And given that business is at a high gross margins of 75%, is there an opportunity to look at 60-65% gross margins, which we typically operate at a company level, and drive some growth there? Because I think post our acquisition, the revenue run rates have largely been stagnant at 4 million.
Yeah, good observation. So the main reason for revenue stagnation is the digital customer acquisition cost, and we want to limit it to certain percentage of revenue. Beyond that, it becomes not a profitable business. And as we are learning more and more about the business, and also adding some more strength to the team in India, we expect this brand to scale in coming future. So, YOY, we had degrowth in last quarter Q3, and Q4 we also may have a little bit of degrowth, but from Q1 onwards, we expect it to have single-digit growth and then get into double-digit growth few quarters down the road. So I'm quite excited with this brand that we have. As a group, VGL Group, we learned quite a bit from the processes, the digital marketing processes from this brand. And this brand itself has a potential to grow with the demographic that we target there.
Okay. And the last question on the UK business. X of Ideal World, constant currency, we've degrown by about 6% Now, UK, since the last few quarters has been struggling, at least on the revenue bit. What are the opportunities you think there are, going forward? Because both US and UK are a large piece of business for us, and UK was negative, and US also, I think, was 3% constant currency. So when we're guiding for 9 to 11% of top line growth, these two geographies have typically, they have to fire, right? So are we seeing some signs on the ground where, customer sentiments have improved or something on those lines?
Yeah, so I'm not seeing consumer sentiment improving. So our guidance is without that sentiment in play, but we are seeing our own internal digital marketing improving in both US and UK. As I mentioned, Vishal Gali had 3x revenue and with profitability, and that learning from each other, all the 6 brands that we have, is percolating within the group in different verticals like Meta, Google, AppLovin, affiliate, influencers, email, all these areas. And that gives me confidence for TJC's growth. In addition to that, we lost 2 contracts for national broadcasting in UK in last 6 months, and we are negotiating with a couple of such contracts, and that contract will also give us growth. So I'm fairly confident that the UK will come back to growth, and US will accelerate the growth.
Okay. All right, sir. That helps. Thank you, and all the best.
Thanks, Shreyas.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I now hand the conference over to Mr. Sunil Agrawal for closing comments. Over to you, sir.
Thank you, everybody. I want to thank all the participants for your time and great questions. If you have any further question, feel free to reach out to Prashant Saraswat at VGL or Amit Sharma at AdFactors PR India, and we'll be happy to answer your questions. Thank you all once again.
Thank you. On behalf of Vaibhav Global Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.